Should all taxpayers be taxed at the same flat rate, regardless of the amount they earn? Is that a fairer, more efficient and simpler tax system? Or does it penalise low-income earners? What are the consequences of reducing the company tax rate? Will it lead to higher wages and greater domestic consumption? Or will it simply increase company profits that are sent to overseas investors? Tax base is a broad term that identifies the types and value of income and assets upon which tax can be imposed. A range of tax bases exist, including income, whether from personal income or business income, including certain capital gains. Capital, such as through the ownership and transfer of property. Domestic consumption, through the purchase of specified goods and services. And production, through business payroll or natural resources, for example. Broadening the tax base means that additional financial streams or assets are taxed. This could occur through taxing new types of transactions or resources, changing the thresholds upon which items are taxed, or expanding the definition of the taxpayer that is captured by a particular tax. Narrowing the tax base reduces the financial streams or assets that are taxed. For example, through exempting a particular asset class, increasing the threshold in which a tax kicks in, or excluding a particular type of taxpayer from a tax. A goal of governments is to identify efficient tax bases upon which to generate adequate tax revenues. In this context, efficient refers to having a broad tax base, ensuring resources are put to their most productive use, and minimising costs incurred by taxpayers. It also refers to taxes that don't alter or distort taxpayer behaviour and choices. The quest for efficiency can therefore significantly limit the tax bases that are actually implemented. The total tax revenue can be calculated by multiplying the tax base by the respective tax rate. Tax rates differ across the different tax bases, and they also differ between jurisdictions and over time. Progressive tax rates refer to the situation where the tax rate increases as the level of the income stream or asset increases. This is the situation in Australia with marginal tax rates for individuals and reflects the equity concept of ability to pay. Proportional tax rates refer to the situation where the same rate of tax is paid regardless of the level of income stream or the size of the asset. This was the situation for Australian companies for many years, with the same flat rate of tax regardless of size or profitability. Regressive tax rates, on the other hand, refer to the situation where the tax rate reduces as the level of the income stream or asset increases. This is effectively the situation for excise duties and lump sum taxes that disproportionately affect lower income taxpayers. In addition, there is a difference between the statutory rates of tax, that is, the amount specified in the legislation or regulations, and the actual tax rate for the particular taxpayer. Differences exist because of various concessions and exemptions that may be available for certain types of transactions, assets, and situations. Tax bases and tax rates are a component of tax policy, and they change over time based on developments in a range of broad environmental factors. They are designed to generate adequate tax revenues for the government, whilst holding true to other policy objectives, such as equity, efficiency, and simplicity.